Types of products in commercial banking. Commercial banking has traditionally been the backbone of banking. Banking was created to funnel idle resources in households to productive purposes in business. Over the long period of time that banking has been in existence, the nature of products provided to commercial customers has undergone a huge change. Several new types of products have been introduced in response to the changing demand in the marketplace, and certain old products have become obsolete. In this article, we have listed down the products that are currently offered by banks to their commercial customers. Industrial loans. The primary business of commercial banks is to make loans to large industrial corporations. Corporations in any nation are interested in obtaining debt at favorable terms. The bank is in a position to fulfill this demand through the service that they offer. Although with the evolution of the debt market, the idea of banks as the principal source of debt has become outdated as far as mega corporations are concerned. Mega corporations are in a position to raise funds directly from the markets. This proves cheaper since they do not have to pay an intermediary, the banks. Therefore, in the past century or so, banks have seen their primary business declining. To combat this decline, they have created special terms which provide capital market services and assist clients in issuing their debt securities. Banks have centuries of experience regarding dealing in debt markets and hence are in a position to provide their expertise for a fee. Therefore, debt market advisory has become one of the major products that banks sell to mega corporations. Project finance. Project finance is one type of loan for which mega corporations largely rely on banks till date. In case of project finance, the banker finances the project as an individual entity. The parent company that is sponsoring the project has a limited liability in case the loan goes bad. For instance, if bank funds DEF project that was initiated by ABC Corporation and the project goes bankrupt over time. In this case, banks only have access to the assets owned by DEF project. ABC Corporation doesn't have to assume any liability for the losses the bank incurred while financing the project. The project is treated as a separate entity in its own right. Syndicated loans. Banks oftentimes combine to make huge syndicated loans to corporations. This is because the debt requirements of a particular corporation, let's say General Electric, may be so huge that any single bank may not be in a position to fulfill them without creating a significant risk on their book. Hence, in such cases, several banks have to form a syndicate to fulfill the loan requirement. One bank may play a lead role in coordinating with other banks and making the funds available to the corporation. Hence, this bank would be called the lead financier and would be entitled to special fee over and above the regular interest that is earned on the loan. Also, the corporation will service the loan, pay the payments to this bank only. It is the lead arranger that will have to create a mechanism to redistribute the monthly payments to the other banks proportionately. Thank you.